Welcome back to our home buying workshop series. I am glad you're here. I'm Rhonda Porter, and this class will be focusing on the money portion of buying a home, from the down payment to the closing cost. And by the end of today's workshop, you'll have a deeper understanding of the funds needed to buy a home and the different closing costs involved. And you'll learn about different ways to come up with funds for closing. We're going to cover a lot in this workshop, and after the workshop, I'll update your dashboard with today's recording. If you don't have a dashboard yet, please let me know and we'll take care of that. So my goal is to keep the workshops to 1 hour, and sometimes we may wrap up a little earlier. We'll have questions and answers at the end, so please leave them in the chat. And after class, you'll receive an online dashboard. Save that link. This will be updated with a recording of any of this workshop, plus any homework assignments or other things I may find useful. Last but not least, please RSVP for each individual workshop so you can receive the link to attend. The links are different for each workshop. So a little about me, I have here on the screen, but my favorite part about my job is helping people not only become homeowners, but also to help educate so they can make informed decisions on whether they buy a home or not. So it's a very important decision, and I take a lot of pride in helping people with that. And I've been helping people with their mortgage needs since 2000 and have been teaching home buyers for quite a while. Before my mortgage career, I was in the title and escrow industry, and I often help people at the end of their transaction when they were signing. And it's such a big day when you're getting ready to buy. And quite possibly it's the largest, most important purchase of a lifetime. So especially when it's your first home. So at our last workshop, we talked about credit, and going over the funds for closing also takes place during this phase of the home buying process. And it's what lenders often refer to as the pre-qualification stage. And as a lender, we need to know where all your funds are coming from. And that's what we're going to cover today. So a big misnomer is that you need 20% down for your funds for closing, and it's simply not true. You might be surprised to know that it could even be little to no funds to get into a home, depending on the mortgage program and if you're using a down payment assistance, or if the seller is helping with closing costs. It's possible to not have to break the bank to buy a home. Most of the funds needed to buy a home are either considered to be part of the down payment, the closing costs, which is a one-time fee associated with buying a loan, or reserves and prepaids for property taxes and homeowners insurance. There may be other costs too that are technically not part of the mortgage process but are recommended, such as different types of inspections for the home. Inspections are often optional, but some programs may require them, like our state down payment assistance program often requires that you have a homeowner's home inspection. So this is an overview, and I'm going to break this all down for you, but we typically, the different types of money that you'll need, and these are phrases you're going to hear throughout the process, would be an earnest money deposit, home inspections, the appraisal deposit, down payment, closing costs, reserves, and I like to have people personally to have at least 2 months of their mortgage payment in the bank after closing, but that's just my personal wish. So I can't force you to have that, and most programs don't require that anymore. Having extra savings after closing can sometimes help with your loan approval too. So, but again, it's just my personal wish for you. So the down payment is the difference between the loan amount and the sales price. So some programs like VA for our veterans or USDA, which is located in rural areas, don't have a down payment requirement. Other programs have a minimum down payment requirement, like a conventional conforming loans can have a 3% minimum down or 3.5% minimum down for an FHA loan. So the down payment percentage is based on the sales price. So if you have a $100,000 home and you're doing a minimum down conventional loan, 3% down would be $3,000. And it's possible that you may qualify for a down payment assistance program or a grant to help go towards the down payment as well. And if you wanted to, let's say, put more of in the minimum down, you can do that too. Closing costs are the one-time fees associated with financing the home. Some fees are lender fees, which would be like processing and underwriting fees. Some lenders will lump these fees all in together and call them something like processing or funding or whatever, underwriting. And other lenders will line item these fees out too. So they can be called different things. Points are optional, and they are the cost associated with your interest rate and how you price the interest rate. So you can opt to pay more in points for a lower rate or less in points, and then your rate's going to be slightly higher. So, and we're going to go over that in more detail today. There's also third-party fees like the appraisal fee and title and escrow fees. Title and escrow fees are based on the sales price or the loan amount, and the appraisal fee is going to vary depending on the type of appraisal that's required, the type of property, or if it's a rush. And in some circumstances, the appraisal may be reduced or waived, depending on what the program is and what our underwriting findings are, which again, we'll go over that in another workshop as well. And then there's what we call government fees, such as recording fees, which is the cost to record your deed, which puts you into title, and the deed of trust or mortgage, which lets the world know that you have a mortgage on the property. Reserves and prepaids are the property taxes and homeowner insurance that are collected, and lenders will collect enough funds to pay for the annual homeowners insurance policy plus a few extra months for a cushion and about 6 months roughly of property taxes. Prorated interest is also collected based off the date of closing towards the end of the month. And since we're talking about reserves and the lender collecting this monthly, let's take a moment to review what's in your mortgage payment. So your mortgage payment is going to include your principal and interest, and as well as the property taxes. And your property taxes are going to be, we take the annual amount and divide that by 12, so it goes into each month's payment. The homeowner's insurance, which you get to shop for, and again, it's the same kind of math that we're going to divide that by 12. That'll be part of your payment. And there may be mortgage insurance as well if you're doing less than 20% down or you have an FHA loan. So the property taxes and homeowners insurance portion are collected and saved each month in an escrow reserve account and paid when taxes are due, which is twice a year, and when annual homeowners insurance policy is due, which is going to be once a year. Your property taxes are based on a percentage of the tax assessed value. So roughly 1% of the sales price. And some areas are going to have more expensive taxes. Some might be a little bit less. It's going to depend on what levies have been passed from voters. And so think of all the times when something's being passed that you vote on, and it's going to be based on a home's value. This is how that gets paid. So property tax portion of your mortgage payment can and will change when the tax assessor determines what the value of your home is. So if you're purchasing a home and it's priced a lot higher than what the assessed value is showing, you can probably expect your mortgage payment or the tax portion of your mortgage payment to go up a bit. But the principal and interest portion should not change if you have a fixed rate program. With homeowners insurance, you get to select your homeowners insurance provider. Typically, you're going to want to do this after your offer is accepted, and you're going to want to start shopping and comparing premiums. You may want to start shopping with who provides you your auto insurance, but their fees and deductibles can vary quite a bit. The lender will need to know who your insurance provider will be once they decide, since this is part of your payment, and it actually goes into part of qualifying you. So when is all this money needed? So it's going to be at different stages of the transaction. So when you're ready to make an offer, you're going to have to be ready to provide the earnest money deposit. It's going to be when the offer is presented with the purchase and sales agreement. And this is something you're going to want to discuss with your real estate agent, because the amount of the earnest money deposit can vary. It can be anywhere from 1% or lower, or it could be quite a bit higher. And it's going to depend on how competitive the situation is for the home you want to make an offer on, as well as other factors. And to keep in mind, though, that the earnest money will be credited towards your down payment at closing. And we'll talk more about earnest money too, because it's very important in a future class. The home inspector will also want to be paid at the time of inspection. And so the home inspection can sometimes take place just before you make an offer or just after you make an offer. And your real estate agent will probably help you select a home inspector. Once your offer is accepted and your loan is in process, expect to pay the appraisal fee because it is a third-party fee, and most lenders will allow you to pay for this using your credit card. And the appraisal amount, again, is going to really vary depending on the property type, and it is as well as the turn time and the type of appraisal that's required. The down payment and closing costs will be due just before the closing date of your purchase. So you'll provide the funds to the escrow company who's taking care of the closing. So here are some acceptable sources for the funds for closing, and it's broken into two categories. We have the down payment and the closing costs. And so with the down payment, we can accept, you have to show proof of your funds is what we're doing. So you have to show your bank account statements. And if there's any large deposits that need to be documented, they will also need to be shown, like where those funds came from. You can use other asset accounts such as your stocks or bonds, gift funds from family members as long as the funds are documented. Your retirement funds are a possibility. Loans against your 401k, an IRS tax refund is considered an awesome fund to use. You can sell an asset like if you had a car or something like that you wanted to sell, but everything has to be documented. Down payment assistance programs are also a possibility for your source of funds for your down payment. Now your closing costs, all these funds, all these sources are fine to use as well. And closing costs can also have a seller contribution. So they'll be allowed to contribute up to a certain amount if it's negotiated in the purchase and sales agreement. But the seller contribution cannot go towards the down payment. So just those other funds can. Your funds are it, or a down payment assistance funds or a gift from family member. And it's just the one thing that is not allowed is cash. So because we can't document where the cash came from. So even if you've had cash stashed away in a safe at home for years, we can't use it. So it's very important that everything is documented. And just to keep in mind that you cannot provide a lender too much documents. Underwriters love it. And it's what we call verified funds. And so that's what you need to be providing your lender. And so they're going to ask for, when you provide an asset account statement, like one from your bank, it's going to be all pages. Even if the last page is blank, even if there's 40 pages, if that's where your funds are coming from, that's what we need. And in a PDF format is fine for that. The statements cannot be altered at all or have anything marked out. We've seen that sometimes with somebody just, they feel it's not anybody's business or anything like that. And we're not being nosy, but it's just a standard requirement because of fraud that has happened in the past. And so everything has to be seen and documented and verified. And it's literally every penny is accounted for when you're buying a home. So here are some down payment examples. This is based on a home priced of $500,000. And so if a conventional loan, we can do a minimum down payment of 3%, which would be $15,000 down payment. FHA at 3.5%, we would need $17,500. For VA or USDA, it could be 0. And for a jumbo loan, which right now, and this is going to change here soon, loan amounts over $806,500, unless you're in a high balance area like King County. It would be 10% down. And again, this is not factoring in having down payment assistance. And there are so many down payment assistance programs available and grants available. Some do have restrictions, such as to income or where the home is located. So there are different things to factor for when you are looking at down payment assistance. The Washington State Housing Finance Commission offers a very popular down payment assistance program, which I can help you with. It is the Home Advantage program, and they have other down payment assistance programs as well. And with how this basically works is that this down payment assistance program is repaid when you go to sell or refinance your home. It's basically a silent second without getting too technical. But the interest rate is at 0% interest. And the rates on the first mortgage tend to be higher when you have a down payment assistance program. And then if you opted to not have down payment assistance, and that's when it's always important to compare the different programs that are available to you so that you can make a choice that's best suited for you. We have a down payment assistance program as well, which also offers up to 100% financing, and it's also in form of a second mortgage. Our second mortgage does have an interest rate that can vary. And the other difference between ours and Home Advantage is that our credit score requirement, I believe, is lower and there are no income limits, and you can buy a duplex, which is possible as long as you're living in one of the units, which could be a great way to start an investment portfolio. The down payment assistance mortgage, as I mentioned, does have an interest rate, and the Home Advantage program does not. So it's really important to compare what all your possible options are. So this case study I keep sharing with you, and this is from our earlier workshop, and they bought their home using Home Advantage and with the down payment assistance, and they only really had to provide the earnest money with the way that we had this loan structured. So they got into this home for $2,500 basically. And that's when it's really important to, before you start shopping for a home, meet with your mortgage advisor, which I'm happy to do that for you, and to create a plan on how you want to buy your home. And so we can put our heads together and create this for you. There's also grants. Grants are a little bit different than down payment assistance. Typically, they're not repaid. They are often limited and the funds can run out. The Gold Grant is just one example. And it's important to know that these programs are out there and to work with a lender who knows how to find them for you. So the seller is also allowed to contribute towards your closing costs, but they cannot contribute towards your down payment. Those have to be your funds or other allowed funds, such as from a gift from family or down payment assistance. But in order for your seller to be able to chip in towards your closing costs, your real estate agent needs to negotiate this in the contract in the purchase and sales agreement. And so if it's a really hot market or a seller's market, this can sometimes be challenging. So it's not always a possibility. It's just going to really depend on the home. And that's where your real estate agent is going to be able to advise you on that. But I like to work with my clients and their agent to show different strategies to help make this a possibility if we need to have the seller help contribute towards your closing cost. So with your funds for closing, it is so important. I'm going to repeat it over and over again, but all funds used for closing or purchasing your home has to be verified as to where it comes from. So lenders are going to review your asset accounts, like your bank statements line by line, and any large deposits will have to be explained and documented. So a large cash deposit, if we can't source it, it can ruin a pre-approval. And if it's a deposit from a family member or a gift towards down payment, we might be able to document that and everything can be fine, but just communication is key with your lender. Seasoned funds, you may have heard of before, and it refers to funds that have been in your personal account for 2 months or more. And accurately, it's going to be more accurately, it's going to be 2 months bank statements without showing the deposited funds. Then we don't have to source it. Those funds are considered yours. So if you had a big garage sale or sold something for cash, you could deposit it and wait until you have 2 bank statements that do not have that deposit showing, and then we don't have to document that. Where this can become an issue is if for some reason we do have to go back another month, and that might be for another reason, like we're having to document other income or something like that. So sometimes it can be a can of worms. So really important to communicate with your lender and just be prepared to show bank statements. 401k loans can be a great resource for buying a loan or for buying a home, excuse me. You can often withdraw a certain amount of the funds from your 401k, or better yet, in my opinion, you might be able to borrow against your 401k. So you need to check with your employer on what's available, or your plan administrator. When you do borrow the funds from your 401k, you often pay yourself back. So you stop putting in your contribution that you would have been making, and instead you are paying the loan back. So you have the same money going out, and you pay yourself back with interest. So the only potential downside would be if you leave your employer, it's possible that that loan might be due immediately. So do check with your employer to see what your options are with your 401k. And again, if you're not already contributing to your 401k, please consider it, because it is great. If your employer offers a match, that's just basically free money for you. So if they, let's say they only match up to 3 or 6%, just see if you can contribute up to that amount. It's a pre-tax contribution. I'm tongue-tied, sorry. So you may not notice that deposit or that savings that you're building as much as you think. And whether or not you are planning on buying a home or using a 401k to buy your home, I really encourage you to check it out so that you can be building towards your retirement if you're not doing it already. So do please check with your employer about any 401k plans if you're not already participating in one. Family and friends can be another possible option for funds for when you're getting ready to buy a home. So if you are planning on getting married or graduation or future housewarming or early inheritance, I mean, there are a lot of special reasons that someone might want to consider giving you money. And as long as it's properly documented, it can work. So these types of funds would generally be considered gifts. And again, do talk with your lender before you get a chunk of change from a family member or a friend. So when a family member helps out with a down payment, the buyer doesn't owe any money on that tax, does not owe any tax on that. It's because it is a gift. However, if the amount is over the annual limit, which is $19,000 per person in 2025, the giver or donor may need to file a simple tax form. And it's just for record keeping, it's not a tax bill. And this is for tracking the lifetime gift exclusion, which is, as of this workshop, just under $14 million, which very few of us will receive that size of a gift, sadly. I know I won't be. I wish. Documentation is key for your donors. They should keep a proof of the transfer of the gift and check with their CPA to see if they need to file an IRS form to disclose the gift. So your generous family member, if someone does decide to give you some gift funds, will have to sign a gift letter provided by the lender, and it's a standard generic form. And the easiest way for the gift to be provided is typically to have the family member wire the funds directly to the escrow company just before closing. And the escrow company will provide them specific wire instructions for them. Sometimes a bank statement from the donor may be required if the wire is not clear that it's coming from them, or if you're using an FHA or USDA mortgage to buy the home. So do check with your lender. And if you receive the funds personally, instead of having them wired to the escrow company, we may have to show bank statements or canceled checks, which some from the donor, which some donors prefer not to share sometimes. So it can cause more documentation for your end as well. So I typically try to recommend in most cases that the donors wire directly to escrow. And if you're planning a wedding, congratulations, and a home purchase, here's a fun fact that wedding gifts can go towards buying your home. So lenders will often accept funds as part of your wedding as a gift, as long as we can show proof they came from the event. So that means your celebration can literally help you start your life together and buy your first home. And if you receive a cash gift, I would ask the donor to instead write you a check and write wedding on the memo. And speaking of weddings, a few months back, the Seattle Times wrote an article about how much the average wedding cost now, and they said it was around 50 to 65,000. And I wrote a blog post on Mortgage Porter, which I'll share with you in the dashboard. But I decided to compare using the funds for the wedding from around 50 to 65,000 to how much someone could buy for a home instead. And so, I have examples here of a condo at 350,000 to a home priced at 1 million. So with 65,000 to buy that home. And I know getting married is hopefully a one-time event, but 50,000 is a lot of money, in my opinion, to spend on one day if you're also dreaming about owning a home. So this is not factoring in also if the seller were to contribute towards the closing cost, or if you had any down payment assistance or gifts from family. But it is possible with these scenarios to buy $1 million home with $65,000 for your total funds for closing. And I know 50,000 can be a lot to come up with. Remember, the seller can contribute towards the closing costs based on the loan to value and the program type. Down payment assistance programs may be available, and family can also possibly gift funds. And another reason to consider not having a big wedding, maybe just scale your wedding down a bit and use money for buying a home instead, is check out the forecasted appreciation based on King County for each of those home scenarios that I shared with you. that 350,000 condo could gain you 155,000 potentially in 5 years. And that's just appreciation. The $1 million home, we're looking at 383,000 potentially. So you'll have a much better financial return on a home than you're going to on memories of a beautiful memory. And so, and it doesn't even have to be a wedding. I know I'm kind of picking on that. It could be a $50,000 boat or car that you pay cash for. And also, if you're considering financing something that's 50,000, like buying a new car boat, please watch my workshop on credit or reach out to me first. So different loan programs and different amounts of down payment, which is the LTV column on this, determine the or loan to value is what LTV is, determine the amount a seller can contribute if negotiated in the purchase and sales agreement by your real estate agent. So it's very important to keep your mortgage professional in the loop when you're getting ready to make an offer. And if your agent is successful in getting more credit than what's allowed, lenders will try to use it to buy down your interest rate. If they're not able to do this, then that difference will be refunded back to the seller, which doesn't happen often. We do our best to use up that credit. So funds are contributions that come from down payment assistance or the seller or a gift from family member can all be combined. And the seller contribution, though, can only go towards closing costs. And the bottom line is that any contribution means less funds needed from you for the closing to buy your home. Another way you can reduce your funds needed for closing is by how you price your interest rate. This is just to illustrate how points work. This is not live pricing, and we're going to go over more of this in an upcoming class. But basically, when locking or pricing your mortgage, mortgage rates act kind of like stocks, and because they're based on bonds or mortgage-backed securities. And you can select a rate based on that current pricing at that moment in the day, and pay a certain amount for that rate. So like pricing, like stocks, change constantly until you lock in your rate. So the cost for the rate is what's referred to as points. And so a point is generally 1% of the loan amount. So if you wanted to price your mortgage with 1 point in this scenario, you would have a 6% rate. And if the loan amount was 400,000, that would cost you $4,000. And so if you really wanted a rate of 5.5%, you could pay 2 points or 2% of the loan amount, which would be $8,000 in this case, if this were the pricing at the time of locking. Or if we needed to reduce your closing costs, we might look at 6.5% for an interest rate which would have no points or no cost. This is often referred to as par pricing. You might even get what's called rebate credit if you were to opt for a 7% rate, which would give you $2,000 credit towards closing costs based on this example. Of course, what payment you qualify for or what you want to have is also a factor. It's all a balance and why you need to have a game plan in place when you're getting ready to buy a home. I look at break-even points, how long it takes for you to break even on the cost of paying a point. Sometimes it may not really be worth paying extra in points if you're not planning on staying in the home long, or if we think there's going to be an opportunity to refinance in the future. And we also consider somebody's personal plans or how long they plan on keeping a mortgage. There is a strategy in how you price your rate. Another option for clients to reduce their funds for closing is to have their actual closing date be at the end of the month. And if you closed it in the middle of the month, you could have 15 days of prorated interest, which would almost be half a mortgage payment. So closing at the end of the month reduces the amount of interest due. Whoops, I scooped on you. And then after closing, again, as my Nona would say, Rome wasn't built in a day. So please do try to keep extra funds. If possible, it's my personal wish, 2 months of your mortgage payment in savings, because you are going to have additional costs that are going to come up on you. You might have furniture, appliances, you might need new window coverings, and there's always going to be ongoing improvements and maintenance when you own a home. So try to keep 2 months in savings. You're going to get a lot of offers for credit extended to you after closing, so just really be careful and mindful. And remember, as earlier in my slide, your potential to enjoy appreciation is one of the benefits that you get from paying down your mortgage, and tax benefits that you receive also from owning a home. So even though I feel like the screen before, I'm kind of like a little bit of a scaring you a little bit possibly with talking about emergency funds and cost of owning a home. There are these benefits too. So here are some tips to help build savings, because you'll never miss out on funds that you don't see. It's a good time to review your credit spending habits and create a budget. Maybe there's things you don't really need or adjustments you can make to save. Also, check out your 401k program. If your employer offers one, they are a great benefit. And make sure first that before you start focusing on saving, that you are making your payments on time, or at least the minimum payments due, and that you're not over limit on any accounts. Then focus on your savings. This is just general advice, and you really do need to have a consultation with a mortgage planner before you get, and to help create a serious game plan before you start making some significant changes to your savings or spending or credit. With your plan, part of it could include reviewing your spending, as I mentioned. And this is something that's great to do whether you're buying a home or not. There might be things that you can eliminate or reduce. I like to go through my bank statements and take a look at it. I'm often don't think about things I've subscribed to. It's easy to forget about these little costs that can all add up. And it's like right now we're keeping a list of what we're watching on TV, which isn't a lot, but winter months you start to watch a little bit more, and so we're trying to see what stations we can unsubscribe from. You may also want to start practice making your mortgage payment. So if you're planning on having a mortgage payment that maybe is a little bit more than what you're currently paying in rent, take that difference and put it in an account marked for your savings account. And in a year or so, you'll have a savings built up that you didn't have before. I would also look at saving your bonus money. This might be any extra money that you receive, such as a bonus one time from work, or if you receive a raise, maybe take that difference and put that away into savings, or if you receive a tax refund. These are all things that can help build towards savings for your account. So now that you have all this extra money and to buy a home with, where are you going to keep it? I mean, you can't keep it cash, right? So it needs to be deposited. So you want to put it in your bank or a credit union, and because you're going to have to provide your lender with bank statements or credit union statements showing your funds in the bank. So be prepared, as I mentioned earlier, to show 2 months bank statements and ideally in a PDF format. You're going to have to show all pages, even if the last page is blank. If you've received gift funds, they cannot be wired directly to the escrow company just prior to closing or to your account. And if they are going to your bank account, then you're going to have to possibly have your parents or family members show their bank statement as well. It's all about proving where the funds come from. So funds for closing, again, the earnest money check. The earnest money is going to be due when you make an offer on the home. It is presented with the purchase and sales agreement to show that you are an earnest or a serious buyer. The appraisal will be paid for once the offer is accepted, and hopefully after you're happy with the home inspection. This is typically done with a credit card at the time the appraisal is requested. The balance of the funds due at closing to the balance of the funds that are due at closing will come from the escrow company, and this is where you're going to bring the funds to. And the escrow company will have been designated on the purchase and sales agreement. And typically these funds are going to be wired or sent via cashier's check, and the escrow company will provide you with instructions on how to do that. And so this slide is one I borrowed again from our workshop on credit, because I know I kind of touched on this earlier, but it's going to depend as far as if you should pay off debts or save for your down payment and closing costs. You really need to meet with a mortgage professional to create a strategy that's right just for you. Some people maybe need to focus on paying off some debts and maybe just paying off just a little bit to help improve their scores. And other people should be, really saving up a little bit extra. And some may need to do a combination of both. So having a personal game plan created by a mortgage professional is critical. So congratulations again, you've taken another step towards homeownership, and even if you don't buy now, you are working towards becoming more financially responsible, learning about finances, credit, and budgeting, and you've discovered that you don't need 20% down to buy a home, and that there are a lot of options available to help come up with the funds to buy your first home. So, and this is like so important. If you need help creating a plan, I am happy to help you. After this week's homework assignment, oh boy, this homework assignment is to create a budget. And so review what you're spending and where you can make changes. And also review your asset accounts. And for extra credit, review your 401k plan. See if you have one available, and does your employer offer a match? And I will be sending you a link to the workshop dashboard, which will be updated with a recording of each class as they occur. Each module, which you'll see the coming soon box, will contain the video of classes as they happen with the homework. That is optional. And I'll also post questions and answers from today's workshop. If your real estate agent referred you to this class, please be sure to let me know so that I can thank them. And we have several upcoming workshops, including mortgage qualifying basics, income and employment, the mortgage process step by step, financing options and types, navigating the real estate market, home inspections and appraisals, what happens from offer accepted to closing day, and what happens after closing. So we have a lot coming up. I hope to see you at one of our workshops. And remember, each class is an individual link, so you have to go to mortgageporter.com/education to sign up. And I don't see any questions in the chat. You don't have to wait for my next workshop. If you want to talk or want to know more, you can scan this QR code or reach out to me via my contact information here. I'm always happy to help you or anyone that you know with your mortgage or home buying needs. I hope you have a great rest of the week, and I look forward to talking with you soon. Take care and have a great day. Bye-bye.